I think trading's a tough enough sport as it is without all the pressures of trying to get everything right. I think sometimes you just need to be able to take a step back and just analyse the charts and then reset sometimes. And so, just some basic concepts just to make sure you're applying this each time. Because the most important thing for us as traders is to be able to just look at the areas of value. And so, we're looking at the Nasdaq on the 4 hour. And so, how do you kind of start to look at these things? Well, clearly we're on a big uptrend, right? You can just see, where the swing ranges are. So our first step is just, where's the swing range? Well, the swing range is just, the top to the bottom. Everything inside of that is just internal ranges, right? And so that would have been the initial range, swing range. But then, of course, price comes back in, and then where does it go? It breaks through. And so first you want to identify where's your latest range. So the latest range, as we sit here today, is there, right? It's nice and easy. You can clearly see that's the top of the range, that's the bottom of the range. This pullback here is not the bottom of the range because we didn't break through with this move to the upside. So that's internal. What I mean by that is if price would have done this, would have came down, and then in this move broke through, therefore breaking this high, then this would have been one range up, right? But price tried to come up, came down a little bit, and then broke through. And so this is just internal movement within that same range. And so, nice and easily, we just simply mark that. And the way I mark that is just with a medium-term time frame upshift. We're just here to give us an idea. We don't typically trade on the 4 hour. This is just an understanding of where things are. Down here, I can see a gap, right? And so I would mark that off. You see this little gap here, which is currently untapped. We're dealing with futures here, right? So it's a gap. Usually gaps get closed at some point, but we haven't closed it. That means that the price has not came back to revisit that area, and so it's a gap up that hasn't been closed. So that's an obvious zone that we'd want to perhaps look into. Okay, so next thing we want to just understand and identify is within this current swing range, right? If we perceive that the price is still going to continue up, and why would we bet against the trend, right? I'm not suggesting that it's guaranteed, but you typically want to go with the trend. The concept that we need to figure out in our head is I'm not going to start thinking about going long any point yet until we come into a discounted range, right? Which is to say, if you take something like the VWAP or volume weighted average price, will give us an indication of are we buying where price is high, or are we buying where price is low? Are we getting value for where we're buying now, or value for where we're selling? Let's just say. And so this concept of premium and discount, the red zone is discount, right? So it's where if we think the price of the movements of NQ is going to remain bullish, then we really want to be looking for areas in this zone, right? And so I'm just going to kind of park that to one side for a minute because I want to just show you something else. So let's identify some of the key terminology we often hear within things like smart money concepts and stuff like that, which typically I tend to favour. And this is a fair value gap, right? So far we've came and tapped a 4 hour fair value gap. Great, currently in there, we came below that, right? The next thing I want to say is what else do we have these? You can see price action is fairly balanced here because other than the gap which is there, we pretty much are relatively balanced. We do have a fair value gap here, so we have another one within this range, and that is another area where we have imbalances between price to buy to sell ratio, which is to say when buyers stepped in, price moved relatively quickly, meaning that orders were left behind, and the market likes to revisit these areas. Now these are more longer term elements. I'm not specifically saying that this is where I'm going to trade because I trade mainly on the 5 minute up to an hour. These are zones and areas where I expect some sort of bigger instability in terms of a rejection that could come in. So if price starts to come down here, this is the next zone I would look at. But then the other thing now, so I've got a couple of fair value gaps. I'll probably have to just pick this one here as well because this is a much larger fair value gap here. Mark that one off. Okay, let's get that one across. Marking up the charts. Okay, so just to bring that back into perspective, we have this fair value gap that I would delete now because, well, it hasn't quite closed below it, but theoretically I would say that that's had enough that it's been tapped. We've had a structure break, which is a medium term time frame, break to the upside. So just to qualify, anything up to an hour in terms of time frame I would mark as a lower term time frame. Anything between 1 hour up to 24 hours would be medium term time frame, and anything beyond a day would be a higher term time frame. So this MTF, LTF, HTF is just relative to whatever time frame I've got that on. Now usually what I will do, just as an extra little element, is if I only want to show this on that time frame is between essentially 1 hour up to 24 hours, then I would just set my visibility to only show that on the hour time frame, right? So anything between 1 hour and 24 hours. So that's a good way just to keep your charts clean, focusing only in the areas and time frames that you want to. We've got our fair value gaps nailed. The next thing I want to nail is my order blocks, right? What is an order block? An order block is the zones or the areas within the chart where significant price movement has effectively created a structural shift, right? So for example, being coming down here nicely, we know the trend is bullish, but as prices came down, we had a nice reaction here, and then another reaction there. And so what I would do, I would label that order block, right, or supply zone, or demand zone, where people would step to buy in again. You can see usually what we do is we notify it as the last bearish candle before, you know, the momentum to the upside. Now you could argue actually that this move didn't quite create the structural shift, and so I'm not going to use this one as a demand zone. This one, however, did, right? Price came back in, and then we shot to the upside, creating that breaker structure. Realistically, if we don't create that breaker structure, it's not really institutionally led, i.e. the large candles, these big displacement candles where you get fair value gaps created, etc., can be seen. That you could argue actually that this candle here could be one, and I will put that one in there because, you know, we are seeing them big candles. We just don't see a structural shift. The only thing I would say on this one though is on a lower time frame, I'm almost going to guarantee that you will, and so I will add that in here as a zone that we can call a OB, right? And so I've got that one in there, but it gets a bit messy when you've got these things overlaid. So let's go medium term time frame demand zone, right? That's where players are going to step into the market because they have before. And then we've also got another one here, right, which is a much larger downward shift but still relevant. So this whole zone would be an area where you'd be looking for potential reversals. Remember, right, everything that happens within the swing range, this is all like internally you could argue, yes, we've had a shift on a lower time frame. Like if I was to go into the 15-minute or the 5-minute or whatever, this would definitely be a structural shift, but on the larger time frame, on the 4 hour, it's not, right? So the next thing I want to do is to just say, okay, well, let's just give ourselves some understanding of where we are relative to that zone. And so there's a lot in play, right? If we go down to this area here, we've got, you know, the strong low right the way down here, and the weak high all the way up here, which we expect to break. However, you know, I wouldn't be thinking about going long until we come into these zones here, which is demand zone here for sure, in terms of where we took off from that big push. There's also a fair value gap, and then below that again, if we want to take liquidity, because look, you've got to remember there's also some other elements that we need to just map out that I think are just important concepts to understand, to piece all of this together. Because here's the catch, right? Our job isn't to guess the market, right? Our job is to understand manipulation, right? And so specifically where you see engineered liquidity, this containment of price versus people's lack of understanding of things like where they're putting the stop losses, where they expect a breakout to occur, all of that kind of stuff that goes on is engineered, right? And it's engineered against the dumb versus the smart. And so the reality of how you got to think about this is, firstly, we'll just mark off these areas where liquidity is being taken, because effectively that big move down here, right, that was a huge pin bar, came back up, price comes back up, and then it come back down. But what did it do after that? Took off, right? Why is that important to understand? Just as a quick stop point, why didn't price continue to go down? Well, price was never really going to continue to go down. What price was looking to do, or what institutions were looking to do, is to fuel the move to the upside. Because look, price has come up here, then it's consolidated for a long time, and then you've had the manipulated move before the move to the upside, which is to say, this box here, right, this is where price is manipulated, right? Up, rangy, up, rangy, up, down, down, up. We had a breakdown here, right? But fake move, huge big pin bar, huge clue, right? Then we get what we'll call everyone's kind of like, okay, we're starting to drop, price is going to go bearish. It was never fueled to do that. The move down was nothing more than a huge liquidity grab, because the amount of volume, right, that it would have took to create that pin bar means that there was a shit ton of orders that were stop loss orders and everything else. And then remember as well, the other key component here is people expecting the breakout to the downside, meaning that a lot of breakout traders will have executed short orders, right, really big short orders with stop losses kind of somewhere in and around here. That if you think of an institution, you know, what's their reality? They need to be able to get price and lots of liquidity, because they're moving 20, 30, 40, 50, 60 million dollars worth of orders at a time. And so if there's not enough liquidity on the order book at a specific level, then they're going to get slippage, they're going to get gaps in the order book, which means that the average value or the average entry for the buys is going to be way higher than what they wanted to do for that move to go long. And so you've always got to think to yourself, when you see this, think two things, right? Number one, is this an engineered move? And if the answer to that is yes, it's an engineered move, then what's question number two? Where are we likely to go and take liquidity to get everyone trapped into this idea that price is going to go one way, only for it to go the opposite way? And so we can almost categorically know at this point that this here is a perfect order block. It's a perfect example of what an order block is, because of two things. We know we've had a consolidated area, we've had the liquidity grab that you see here, and then we get that breaker structure. So this is probably my favorite area for long movement, and so I would have a greater potential for the long to continue. Price comes down in this zone and then move back up. When will it come down here? I don't know. This is just some TA, but just those elements there: structural break, liquidity grab, institutionally led. You can just tell by the sizes of the candles, so price is going to the upside. And so mark that one on your chart as like an area where you would think, yeah, that's got a very high likelihood of price continuing up. Now, it's not guaranteed, but this is what we have to do as traders, right? We have to sometimes reset, zoom out a little bit, and then just look at the key zones and the key areas on the chart where, you know, something can be favorable to you. So didn't want to come on too long, just wanted to kind of give a snapshot of some of the stuff that I think is really important to us to know. And so what haven't you seen here? Number one, you haven't seen an RSI. I'm not saying they're bad, but there's no real reason for me to understand what momentum's doing right now. I can see price action, right? I can see exactly what's going on. I can see behind the candle, even though I can't see behind the candle, what this move's actually meant for this move to the upside. And so I know if price comes back down here, this will be defended. You haven't seen moving averages, you haven't seen anything like that, because I think a lot of the time you just don't need it, right? Maybe if you go into smaller time frames, just if you're sniping in and out. But if you're swing trading, you just need to see where the money is, right? So engineered liquidity, market structure essentially equals manipulation. If you can figure out where manipulation is going to occur, you can pretty much be on the right side of the market each time. That being said, speak to you soon.